Hi guys, welcome back to my channel. In today's video, I'm going to go through risk management. So I'm going to go through all of my tips and tricks on how to mitigate your risk while trading options. So that being said, I do just want to say that everyone's risk exposure is going to differ. Obviously, my risk exposure is going to be different from anyone else's depending on my account size, and what I'm willing to lose is going to differ from what you're willing to lose on a trade. So just keep that in mind while we're going through this video. All right, guys. So when I am talking about risk management, I have three rules that I follow. So the first rule is only risk what you're willing to lose. This is a pretty simple concept, but I see a lot of newer traders really struggling to grasp it. So what I mean by risk what you're willing to lose is that you should be okay with losing that whole entire position size. Obviously, you're going to do everything in your power to mitigate your risk and to obviously not lose that whole position. However, on the off chance that you get emotionally invested into that trade, you end up bag holding that trade, you need to be okay with losing that entire position size just in case, you know, you kind of let your emotions get the best of you, because that can happen. And I think people fail to realize that. Obviously, like I said, you're going to try to apply proper risk management to make sure that you don't lose that whole position. However, like I said, there is that chance. So if you're not willing to lose that entire position in said trade, I would not be sizing as much as you are. Now, rule number 2 is that you should never risk more than 20% of your account. Now, when I say 20%, I'm sure all of you are like, oh my God, that's so much. Obviously, it is a lot of your account depending on your account size. However, the key word there is no more than. So keywords. So you don't want to risk more than 20% of your account on any given trade. On the obviously the higher end of that, if there's a high probability setup, you know, market is moving in a downtrend or uptrend and everything's following, obviously you like to size up during those times. That's perfectly fine. However, if you're taking, you know, day-to-day trades, you obviously want to stay under that 20% rule. And we're going to break down the 20% rule in depth after I go through all of them, but just keep that in mind. You should not be risking more than 20% of your account. My third rule is gradually size up. Now, when I say gradually size up, I mean exactly what I'm saying. So don't go from 1,000 to 10,000 or go from 1 contract to 10 contracts. Gradually position size up. So it's going to be a lot easier for you to go from, you know, 1 to 2 contracts versus 1 to 10 contracts. And we'll break that down as well. So those are my rules that I follow when I'm, you know, applying my risk management. Make sure that you are willing to lose the whole position size, no more than 20% of your account in any given trade, and make sure that you are gradually sizing up and not going from 1 to 1,000 and slowly going up. All right, guys, so there's 2 ways that you can break down rule number 1 and rule number 2. So say, for example, you have a $1,000 account. The first way that you can break down your account is by sections. So you can section the account into 5 trades or 10 trades or 8 trades, whatever you want to do. So say, for example, you want to section the account into 5 trades. That means per day, you have 5 trades to take, and each trade is a max of $200 per position. So you could only risk up to $200 per position that you take on those 5 trades. 5 trades is the max. The $200 is the max position size. Obviously, you don't have to take all 5 trades, but that gives you a little bit of a cushion in case you do take a loss on the first trade or second trade. You have potentially additional trades to make up for it. On the opposite hand, you could also break down that $1,000 account into 10 trades, which will give you $100 per position size. It really depends on your risk exposure and what you're willing to risk on any given trade. The second way that you can break down an account is by percentage. So when you're breaking your account down by a percentage, this means that you're only willing to apply a certain percentage of your account into any given trade. So say, for example, you want to only have 10% of your account into any given trade or 7% of your account into any given trade on a $1,000 account. So say, for example, you pick the 10%. That means that on any given position that you take, you cannot risk more than $100 on your $1,000 account. This mitigates your position to $100, 10%, and obviously we'll go through max loss in a little bit, but depending on your max loss that you're willing to take, it's a lot lower than if you were to go in, say for example, on one big trade with $500 with no risk management, nothing in place to keep you in line, and take an even heftier loss on your $1,000 account. Either by splitting your account by sectioning it into multiple trades, or splitting it by a percentage of what you're willing to lose. Both of them are applying proper risk management. You have a plan in place in case the trade doesn't go in your direction, in case you dig yourself a little bit of a hole in the morning or in the afternoon and you need to make it up. Now, let's break down position sizing. So what I mean by gradually increasing your position size is that don't go from trading with one contract to trading with 10 contracts. You want to take it slow. So for example, how I, started to gradually increase my position size and, got to where I am currently. What I like to do, and I usually tell all of my students this, is that if you have, say for example, you're trading with one contract right now. If you're trading with one contract, you need to be consistently profitable on the week for 3 weeks straight before you size up. So what I mean by this is that for 3 weeks straight, you should be coming out green on the week, every week. Obviously, if you take 3 bad days, you have 3 red days and 2 green days, I would pay attention to that and see what those red days were about and kind of start the following week. If you find that you're not taking high probability setups, you're kind of getting lucky here and there, make sure that you're reviewing your trades at the end of the week prior to deciding whether you're going to accept that week as a green week or you're going to accept that week as a red week, either if you were green or not. So that's a big thing. Just because you're green, make sure that you're analyzing, you're reviewing your trades, and you're making sure that you've taken high probability setups, you followed a strategy, you followed proper risk management. That way, when you do size up, you're still following those rules and you're not allowing that increased size to get to you emotionally. So after, say for example, you've been green for 3 weeks and you're trading on one contract, you can then increase your position size by 1 to 2 contracts, no more than 2 contracts. So say for example, you're green on the 3 weeks, you increase your position size on the 4th week, you're now going in with 2 contracts per position size, obviously depending on whatever your account value is, etc., etc. Say you're going in with 2 contracts. What this entails is, so say for example, on that 4th week, you are not green on that 4th week, you then size back down to 1 contract. Okay, so 3 weeks green, you size up. On that 4th week, if you're red, you size back down. Okay, that is the only way to gradually increase your position size without allowing that increased position to get to you mentally. Because a lot of people fail to understand that trading with a higher position or trading with more capital is a different ballgame than trading with smaller capital. If you're not okay with losing $100, you're not going to be okay with losing $500. And that's what a lot of people don't understand, and they increase their position size because they want to make more money, and they're starting to blow through their account because emotionally they were not prepared to increase that position size, and now they've dug themselves an even deeper hole than if they would have gradually done it. Now on the opposite hand, let's talk about losses and taking losses, and where you should kind of set limits to the losses that you take. So whenever I get into a position trade, what I tell myself is that I do not want to lose more than 10% of my position size. So what that means is if I am entering a trade with $1,000, so my position size is $1,000, what that means is I'm not willing to risk more than $100 on that said trade. Now, this will in turn also help you set a stop loss, because then you could set your stop loss to a point where that it will mitigate that risk, it will limit that risk, it'll cap it to that $100. So that 10% rule is something that I follow. If your risk exposure, your risk tolerance is a lot less than mine, then obviously bring that down to 5%, 4%, 3%. Obviously, you want to make sure that you're tolerant of whatever loss that you are going to take. So like I said, this also helps you set a stop loss. You can either set your stop loss 2 different ways. One, as a percentage of what you're willing to lose in that trade that you have, or you can set it based off of support and resistance levels, the price action of the stock. What I've found personally that is a lot more helpful is setting it based off of support and resistance levels, the price action of the stock, because this actually lets your trade breathe. It gives your trade room to breathe, and you are taking on a little bit more risk exposure because your stop loss is a little bit higher or lower to where you entered. However, it gives the trade room to breathe, because what can happen sometimes is the stock will retest and then continue on the trend that it's on. So personally, based off of the strategies that I utilize, I think it's a lot more helpful in kind of bettering your trading to pay attention to support and resistance levels as your stop losses instead of a percentage of your position. However, if you want to mitigate risk, and that is your main and most important thing in your trading, obviously do percentage. So you're not willing to risk more than 5% of your position size, you set your stop loss to 5% of your position size. Obviously still pay attention to what the stock is doing, overall market is doing, and then apply your strategy in that way. Now, in conclusion, I do just want to say that everyone's risk tolerance is different. Obviously, what I'm willing to risk on a position is going to be different from yours. And I don't want you guys to compare yourselves to anyone. You need to compare yourselves to your own journey and what you need to do in order to accomplish your trading goals. So I got a lot of comments on my previous videos in regards to live trading and my position sizes and this and this. You guys don't need to worry about that. What you need to worry about is a strategy that I'm implementing, how you can apply that strategy, how you can learn from that strategy, and so on and so forth. Don't worry about the profits and the gains. That will all come once you have a solid strategy and you've learned everything. The problem with traders nowadays is that they rush to make $1 million in a couple months. That's not how it works. You need to give yourself time to learn. You need to give yourself time to gradually increase your account. I know there's a lot going on with meme stocks and this, but everyone is different and people are getting lucky. I'm gonna just be really honest with you guys. People are getting extremely lucky and they're giving you a false hope in what you can accomplish in a certain period of time. One, you shouldn't cap your trading to a timeline or anything like that. You should go off of, are you consistently becoming a better trader? Yes or no? If you are not, what do you need to change? If you are, continue to do what you're doing. The gains will eventually add up. And just be aware, 20% on a 10K account is $2,000. 20% on a $1,000 account is $200. Both traders took the same exact play. Both traders had the same percentage return, but one had a higher account value than the other. That does not mean that the person that made $200 or the person that made $2,000 is better than the one that made $200, because they took the same exact trade. And that's what people fail to realize and fail to understand. The whole goal of trading is longevity. You want to last in the market. If you want to make trading your full-time job, you need to stop looking at the profits and you need to start looking at how can I mitigate my losses and how can I gradually become a better trader and increase consistency in my trading. That is all you need to know in regards to risk management. If you can understand those two concepts, don't rush your trading, how to become a consistent trader, what can I do to mitigate my risk, you will be able to increase gradually your account. It's not going to go from 1,000 to 100,000 in 3 months. There are very little people that can do that and have done that. It's a lot of mental stress to size up 100 contracts, 50 contracts, 60 contracts. Traders are not talking about the emotional side of trading, the mental strain it has when you're sizing up that much, which is why I've sized down a lot, because it is very mentally straining and people don't understand that, and it needs to be talked about a lot more. All right, guys, so I hope this video was helpful. If you have any questions, go ahead and comment down below. I know there's a lot of information, a lot of do's and don'ts there, so definitely comment down below or shoot me a DM on Instagram. If you found the video helpful, don't forget to subscribe to my page and like for more content, and I will see you guys in the next video. Bye.